So this panel is a market conduct panel. As you know, IAIS mission is to protect policyholders, and we have not overemphasized how important this market conduct initiative under the IAIS. And actually, it's not as catched by like capital or other topical initiative, but market conduct group has enormous work in the past few years and enormous development. And it's led by, this panel is led by market conduct chairman, Olivier Fliche. And of course, the panelist is excellent to talk about the key theme and the key development of market conduct issues. So please come to the floor, Olivier and all the panelists.
Thank you very much, Yoshi. So, firstly, let me welcome you all to this panel on the subject of promoting good conduct in insurance distribution. To help set the scene, I'd like to start with some comments on the role of conduct of business supervision and of the work of our IAIS group. As we mentioned in some of our papers, the financial crisis and its aftermath highlighted the need for financial services to regain consumers' trust in the sector. This trust entails both confidence in the soundness of institutions and confidence that institutions will act in consumers' best interests and treat them fairly. This was recognized by sector policymakers, and they addressed the need to ensure that regulatory and supervisory frameworks address both prudential, which is the traditional, I would say, traditional scope of regulation, and also conduct of business risk. So what I would like to stress is that conduct of business supervisions, of course, promotes good conduct of insurance and intermediaries, but also, in doing so, contributes towards other supervisory objectives, such as financial stability. In our application, or last application paper, we also try to recognize the key role that intermediaries plays in this sector. They provide an interface between customers and insurance, and they really play a key role in building and justifying public trust and confidence in the sector. What we may also, what we should also have in mind in this sector of insurance distribution is the real diversity of the products we find, the customers, the diversity of insurance intermediaries and intermediation markets, and also, and that's a very important point that we have elaborated in our papers, is the different degrees of involvement of insurers and intermediaries in the distribution model, which may lead to a different degree of responsibility. And of course, we also need to be aware of the new and emerging distribution models that might need a different supervisory approach. So all these these factors pose a number of challenges for supervisors, and I would like to mention a few of them. The first of them, of course, is the question of proportionality. In most cases, there is a considerably higher number of intermediaries operating in a jurisdiction than entrants. We spoke about the diversity. And these intermediaries can be, many of them can be very small. So the nature and scale of their activities, their operation, is very diverse, and then pose the question of the application of proportionality. So the supervisory framework needs to take these factors into account. The second point, and I mentioned it also in the first slide, is that there is intimidation actually means that the intermediary is a go-between for the insurer and the customer or policyholder. So we need to consider this specific tripartite relationship between the customer, the intermediary, and the insurer. And this has led us, for example, to pay specific attention to this when we revised ICPs 18 and 19. I will say a word later. The third challenge is, of course, non-face-to-face intermediation. Insurance distribution is increasingly conducted through digital channels, and we need to adapt supervisory approaches to ensure that consumers remain appropriately protected. And the last, maybe the last challenge is to balance the advantages of innovation, competition, ease of access to products against the need for customers to receive an appropriate level of protection. And our job as supervisors is to ensure that consumers receive an appropriate level of protection regardless of the distribution channel, and promoting principles of good conduct and fair treatment will help to achieve this. Before moving on to the panel, I would like to briefly highlight some recent and current IAIS work related to good conduct of business and insurance distribution. Last November, we published an application paper on supervising the conduct of intermediaries. This paper is to illustrate, to give ideas on approaches that IAIS members can consider when they develop or revise their framework for consumer protection. We also have recently updated ICPs 18 and 19. This review has taken into account the results of a self-assessment of IAS members in implementing the current version of ICPs 18 and 19. And we also, of course, took into account market developments, discussion within the working group on all the work we did, and based on all the work we did in the application paper on supervising the conduct of intermediaries, and before that on conduct of business risk. I think a 60-day public consultation is commencing today, if I'm not wrong, so I look forward to receiving your input during this period so that we can improve our draft. Then, looking slightly ahead, the Market Conduct Working Group is now considering an issues paper on the increasing use of digital technology in insurance, and of course its impact on consumer conduct of business and the consumer outcomes. So that was to help setting the scene. I would now like to introduce our panelists and maybe say a word of how we are going to organize the panel. So we will have 4 presentations by our panelists. The first one will be Nick de Marschalk. I hope I pronounced it. I was told that I was not able to pronounce this properly, but there was an international version of the word of the name that I could pronounce, so I tried to. Nick is the director of BPAR, the European Federation of Insurance Intermediaries, and also director of the WFII, which is the World Federation of Insurance Intermediaries, and is going to give us the perspective of intermediaries on our work on ICPs 18 and 19. Then Maggie Craig will give us an example of how a regulator and supervisor implement concretely a new conduct of business regulation. Maggie is head of insurance and pension policy in the strategy and competition division at the Financial Conduct Authority, and one of her key projects is currently the insurance distribution, the implementation of the insurance distribution directive, which has to be implemented in Europe in February 2018. So I think she will give us the insights on this directive and the challenges of the implementation of this directive in the UK. Christian Mikula, who is senior specialist in the Australian Securities and Investment Commission, will give us another insight of supervisory challenges, is currently engaged on a major project in ACPR to address poor consumer outcomes from the sale of low-value add-on products distributed with motor vehicles. And this will provide us a good example of concrete supervisory challenges. And then Birnbaum, who is Executive Director and Economic Advisor for the Center for Economic Justice. The Center for Economic Justice is a Texas non-profit organization whose mission is to advocate on behalf of low-income consumers on issues of availability, affordability, and accessibility. So I would say that's the consumer point of view that will close the session. And so Birny will give us this point of view, this perspective, opening maybe a little bit on the future of insurance distribution. So now I'm going to leave the floor to the panelists. We try to have presentation in 7-8 minutes. And then we will open a round of questions with you to react on on the presentation of panelists and also on the question you may have in the room. Thank you for your attention. Nick, do you want to?
Thank you.
If you've got a presentation.
Thank you very much, Olivier. Thank you. First of all, I would like to thank the IAIS for inviting me here at this panel. Thank you to you, Olivier, also for having me on this panel. and I allowed myself to change the title of this session. Promoting good conduct in insurance distribution, and then I added by promoting good regulation on conduct. I thought that given the audience, it's perhaps more applicable, but I leave the rest up to you to judge. This is our world we are living in as insurance intermediaries, or this is what the insurance distribution world is living in, if I may say so. We are in a three-dimensional box where regulation, digitalization, and new or other client expectations, but also providers' expectations and new risks are in fact all coming together into a box. And every kind of business model, every kind of distribution model is somewhere on a point in this three-dimensional box. But they are all on different points, and I believe that that is important to start with, is that we are not talking about an homogeneous world or an homogeneous system. So digitalization, regulation, and the market are the main drivers of change. At WFII, we are promoting good conduct regulation and good regulation for intermediation. And I say intermediation, not intermediaries. And perhaps we can broaden this now to distribution since the very start. So we are very happy that the IAIS is since then also working on this issue and is developing insurance core principles on this. And we can perfectly live and are even promoting the application in all countries of the world to all kinds of insurances sold, the application of the both principle and standards of ICP 18 and 19. I believe this is good for everybody, but of course always taking into consideration that we are in a heterogeneous world. This being said, I stressed very much that we are promoting the standards and the principles, because the problem may come in the detail, and that is sometimes counterproductive in order to, let's say, if we are in a changing world, the more detailed the rules are, very often the more difficult it becomes to apply them to a very broad activity. And then you are running into problems of level playing field or non-level playing field. Then you are coming also into trouble of what is in and out of scope and how far do we go in all this. So that is perhaps the first point, is that too detailed rules may not be future-proof. We also believe that when implementing the ICP's principles or standards, and I'm talking here from an industry perspective, when implementing them, it should be done with realism and proportionality. Every market is different. Yeah? We had the development panel here just before. I believe that was a very good illustration of the diversity that there is in terms of markets. We should all have eye for administrative burden, because in this world, very often we are in a kind of audit-style supervision now, and the danger would be that it become an industrialized supervision where we lose sight of reality, and that can work both ways. And I believe when we are implementing these principles and standards, I would like to call upon supervisors, but also the industry, to have to take into account a couple of points. And these points may also, Olivier, if you allow me, be useful in this panel. Because too often, for example, the first point, too often I hear discussions where panelists are basically talking about investment or insurance-based investments, and then mixing it up, for example, with the non-life sector. So I believe that it would be reasonable to always make that distinction between, on the one hand, the investment world, on the other hand, the non-life or pure risk life world, whenever we are talking about conduct We also have to make a distinction, I believe, between commercial lines and private consumers. We really have to know who we have in mind. If not, we may over-regulate and we may stifle really innovation or processes. If we are going to apply strict rules that are, let's say, invented or imposed upon consumer insurances, well, if we would apply that to the commercial lines, then I believe we would lose some flexibility there. And I'm not saying that flexibility should be the priority. It is the security and it is the good conduct that is priority, absolutely in agreement with that. The level playing field should be observed, in particular in a market that is changing very quickly and where there is innovation. And there should be also some attention for the fact that the relationship between providers and intermediaries is not, how would I say, over-regulated. We believe that that can be dealt with by the market parties, and the supervisor or the regulator, we believe, should be very careful not to intervene too much into that relationship in order to make sure that the market remains flexible and that there is choice for the consumer among the different business models or among the different offers also in terms of service. So too much detailed regulation may be a barrier to innovation and development and may not be to the wish of a consumer. Is a consumer have to wait 3 days before he gets his green card for his car insurance, and the consumer is not happy these days. Now, if of course you have to fill in and you have to complete or make sure that you are in compliance with all the rules, sometimes it takes more time than necessary and may become a barrier to a fluid process of the insurance process. And that is also part of an intermediation or a distribution role, is to make sure that the process is made fluid and efficient. What we also believe is that changing regulation is as dangerous or as difficult as tough, stable regulation. It creates legal uncertainty, both for those who are investing into the market, but also for the consumer. If the consumer does not know in the long term where it goes, then that also creates some, let's say, or may create some level of uncertainty or may undermine the trust in the market. Then the question is asked in the booklet whether conduct of business is a promoter of confidence and enhancement of reputation. Well, here I would like to say that I see very often that the sector, in general sometimes, is blamed generally for individual cases of wrongdoing. And I think that with the wave of new rules that we got over us in most of our countries, it is perhaps time for regulators and supervisors to send a message to consumers to say, you can have much more confidence today in this market than before. I don't see this message very explicitly, but if you are talking about confidence, creating confidence, making sure that people invest again, making sure that people trust us again, I believe time has come and everything is in place to make sure that you can say that to the consumer. By the way, you are also our supervisors. So I believe these people can have trust in you. I think the system is very strong for the moment in terms of conduct regulation, and perhaps you could help in creating more trust also, or making sure that people can trust us. So I leave it here. I hope that my few comments may help in the debate afterwards, and thank you again for your attention.
Thank you very much for this presentation, which gives a flavor of the challenge we have to face as supervisor. Maggie, do you want to say words on these challenges and especially on IDD?
It's lovely to be here and really pleased to be able to offer some perspective from the FCA's point of view. I should start with a couple of remarks. One is that I suspect this panel is going to generate a lot of discussion, and unfortunately I have to leave at 1 o'clock, so I'm a bit worried that I'm going to be sorry to miss the discussion, but the alternative is a very angry husband waiting for me when I don't get off my plane. So after years of marriage, I'm going to not go with that one. The second one is that what I want to do today is use the Insurance Distribution Directive as a bit of a practical example. But rather than kind of go through the detail of the directive, I want to use it in a kind of explanatory way to just highlight a couple of points. We are currently working on the IDD. This is not our finalised position. It's still coming through in terms of the detail, and we're still working through our position. So I haven't got a major announcement to make on IDD and FCA today, but I just want to give some examples. I think the thing about the IDD is it's extensive. Make no bones about it, this is an important piece of legislation. It covers an awful lot of ground. Interestingly, however, it is minimum harmonising. So that does give us, as regulators in the European context, the chance and the ability to exercise some discretion to perhaps go a little bit further than the IDD requires where we feel it's particularly warranted. So it's quite an interesting one to work with, because certainly at FCA we may want to do more than the IDD does, but if I want to do that leading the insurance policy team, I have to justify to my executive committee and to my board why I want to go further. And that would generally be because we feel that we want to go a bit further to put more consumer protection in, perhaps because our market is different or whatever. So, but what I want to do is take an example. And I assure you that this may sound to some of you in the room as a rather extreme example, and it may be extreme, but it is real. I am not making any of this up. Imagine a firm which is firm-A, and it is primarily a shop, really. It's a retailer. It sells clothing, it sells furniture, it sells electrical goods. Also, they sell product protection insurance, so that if you're buying a fancy new television or a beautiful new sofa, you can buy insurance alongside those goods to protect those goods from loss, theft, or damage to the product. And that may well be something that you would value as a consumer, particularly, as I say, if it's a fancy new television or a beautiful new sofa. And that sounded okay. And then we did a bit of digging, and we identified a few things. First of all, it covered everything that the firm sold. So at the risk of being a little bit indelicate, it also covered the underwear that the firm sold. Now, I don't normally want to insure my underwear against fire, loss and theft, but if I bought that product, that's what I was doing. So that was the first point. We thought, not sure about that. The next thing we discovered was that this firm was taking commission. Not a problem with commission, but the commission level was 80%. 80, not 18, 80%. So we thought, not really sure about that either. The loss ratio was around 1%. There were very few claims ever made, and of the claims that were made, only 60% were actually met. Now, you put that together as a package, and that is not good. That is not good for the consumer, and I would argue it's not good for the industry, because if consumers think that that's what the insurance industry is doing to them, that's not good for the reputation of the industry. That's not good for anybody. It's also not good for regulators who have to try to clear up that mess. And with working with our supervision colleagues, we have agreed a redress for this firm, and we're now talking about 12.5 million in redress. So that is a scenario that we wish would never have happened. So roll forward a few years and imagine that the IDD is in place. What would the IDD do to stop that happening again? Well, the first thing is that this product had a very long distribution chain. Again, nothing wrong with long distribution chains on principle, but what we now have, you had a firm, had a wholesale intermediary, a managing agent, eventual underwriters, a very long chain before you got to the consumer. What the IDD does is impose a requirement that all firms in that chain must act honestly, fairly, and professionally in the customer's best interests. So that's a professional and an ethical rigour, and that's new for wholesale firms. So that would have helped. It also introduces new requirements on product design and product governance. Now, maybe if somebody had designed this product in the first place, they might not have thought about insuring underwear. But it would have identified that this product was badly designed. It would identify that really, what is the legitimate target market? That bits of the product might have been all right, but not all of the product. So product design and then ongoing product governance would have identified that this was not a good value for money product. The IDD also prohibits remuneration of a firm which conflicts with the customer's best interests. Now, clearly, there are judgment calls around high remuneration. What is a high remuneration? Is 20% too high? Is 30% too high? Those are judgment calls. I think 80% is kind of getting beyond the judgment call piece. That's one of those ones we think, really? So you then get into what is the firm being remunerated for, what is it actually doing, and how much is it making. The other thing is that the IDD imposes new requirements on firms selling ancillary products. Previously, they were completely unregulated. So now, the insurer or the wholesale intermediary is, if you like, going to be on the hook for what's going on there. They're going to have oversight of the ancillary intermediary. And that ancillary intermediary may not be at all familiar with insurance, or it may not be their main issue. So they're going to have oversight so that they have to act in the customer's best interests. Effectively, the insurer will be on the hook and will need to make sure that the ancillary intermediary is behaving properly. I've chosen to do it that way because, believe me, and one of my team members is in the audience, he can testify that trudging through the detail of the Insurance Distribution Directive is quite difficult. What I'm hoping to do, that I've done there, is kind of bring that example to life. And I think one of the things around ancillary intermediaries that's very important is, if you are a customer and you are in buying a product, you're in to buy a holiday, you're probably going to be much more excited about the fact that you're going to the US or you're going to Peru, rather than the fact that somebody says, oh, by the way, you do want travel insurance as well, so you don't look at the travel insurance. The IDD is a really important piece of legislation. It's difficult to work through. We need to align it with other pieces of legislation. We need to align it with our own specific markets. But it is, I think, going to be a very effective piece of, a piece of regulation, and one that will make a difference both to consumer and to insurers and their intermediaries.
Thank you very much, Maggie, for this presentation, very illustrative and illuminating on the potentialities of the IDD. Christian, I think the transition is quite easy because your subject is also around add-on insurance, but with car dealer this time.
Thanks, Olivier, and thanks for inviting me to this conference. So yes, I'll run through a case study, an issue that we've been working with in Australia for the last 2 years about the sale of add-on products. What Maggie was saying has a lot of resonance to the issues that we're seeing, although we're dealing with it within a whole market, which is the sale of cars on finance. So what I'll be covering today briefly is a description of the Australian car dealer market, and the structural drivers for the sale of poor value add-on products, the failings by insurers that allowed these systemic poor outcomes to occur, and then discuss how we're looking to drive changes in the behaviour of insurers. The key factor in the Australian car dealer market is that the profitability of car dealers from the sale of the vehicles themselves has been declining, and they've increasingly become dependent, therefore, on commission revenue from the sale of both finance and insurance products. And in the last 10 years, that's become even more pronounced. What that has meant is that products have been developed, designed and priced to meet that need for an income stream, rather than addressing the interests of consumers. In Australia, with a car, you can be offered and sold 5 or 6 different add-on products. Some will insure the risk under the related finance contract, and some will cover risks associated with damage to the car itself. So there's a slicing of the transaction, a number of very small risks that people wouldn't ordinarily think of insuring, to maximise the number of products that can be sold. In terms of outcomes, we looked at findings and analysed data from insurers over a 3-year period, 2013 to 2015. We found that loss ratios across all the products that we saw were consistently less than 10 cents in the dollar, and that some individual insurers had claims rates as low as 2 or 3 cents in the dollar. Conversely, we found that the amount being paid in commissions was significantly higher, that car dealers would typically get at least 4 times more in commissions than the amount paid out in claims. So if you asked who was benefiting, car dealers and intermediaries were clearly benefiting to a much larger extent than consumers. We didn't see commissions of 80%, the highest we found was 79%, but typically they're around 40 or 50%. And this led to absurd outcomes in product design. So there was one product, for example, that would make 3 repayments under your loan contract. Depending on the terms of your loan, the premium might cost more than the amount that would be paid in the event of a claim. So we referred to that as a negative equity product because the consumer could never be ahead, or negative value product. The sales model in Australia for these didn't place any onus on the car dealer to make sure it suited the consumer. They could simply promote it and leave the onus of the decision to the consumer, and therefore the risk of bad outcomes was borne by the consumer as well. And given all that, not surprisingly, competition didn't work. Consumers weren't able to shop around. They couldn't assess the value of these products. They couldn't alter insurers' behaviour. The failings by insurers, why did they allow these poor outcomes? Partly, I think it was incremental, that over the period of time, the car dealers kept asking for higher and higher commissions. So what might have begun as a sort of perhaps slightly high but not unreasonable commission over time became a higher commission. And they were then unable to extract themselves from those arrangements. It's a small sort of market with about 7 major insurers. They could be played off against each other. So if one didn't offer higher commissions, the car dealers would go to the other one. So their choices really were to either vacate the market and stop offering the products, or compete on commissions to the detriment of consumers. And in that context, they missed many red flags. So again, similar to what Maggie was saying, there was no thought about design and consumer outcomes. If you have a product under which the maximum amount you can claim is less than the premium, it's clear that there's a failing at the level of design and anticipating how it would work for consumers. Similarly, there were red flags in terms of claims. So claims might be denied for reasons that would make a reasonable insurer go back and look at their sales practices. We found consistently that claims would be denied because consumers weren't eligible for cover. So, for example, for unemployment cover, they might be in casual employment and ineligible to claim. There was no consistency between eligibility to claim and eligibility to be sold the product. That anyone could be sold the product, but not everyone could claim. In terms of dealing with it, so we've looked to address this in a collective or global way. We're aware of that problem that you can't ask any single insurer to move. So what we're trying to do is move the whole market and try negotiating with them so that everyone moves from an unhappy place to what works better for consumers. We initially undertook that data and analysis over that 3-year period. That sought aggregate data, but it was quite detailed, and we used it to identify a whole range of different ways in which there were problems. We then have approached the insurers at the level of the boards and the chief executive officers to make sure it gets visibility. Some insurers, it was their only product. Other insurers, it was a small part of their business that was largely ignored or run almost independently. We wanted to make sure that there was visibility at the most senior levels of management to ensure that the problems got attention. And we have also conducted a detailed review of the contracts. So when you looked at the contracts, there were a range of different ways in which there might be problems, or they might work against the consumer's interests. So there might be exclusions that are unusual, or the maximum amount payable might be restricted in a way that was a rational, well-informed consumer wouldn't buy it. So we've undertaken that analysis and again presented that at a senior level and said that there needs to be a whole change to your processes. And in the future, and we've just started this process now as well, we're undertaking a detailed data request. So we'll be asking insurers to provide contract by contract data so we can see who's selling which products to which consumers and identify very quickly from that patterns or concentrations of outcomes that might suggest things need or that there's problems in particular areas. So for example, if one car dealer is selling lots of life insurance to 18 to 20-year-olds, we'll be able to identify that very quickly and tell the insurer we want you to look at that and give us an explanation. That's being done under our existing powers, but it is foreshadowed that there will be design obligations on insurers similar to the ones Maggie was describing in Australia, but that's still being worked through by the government, so the shape of those are not known. It's clear that there's a reputational risk for insurers that this market hasn't worked, and certainly some of them have responded by exiting the market, that they've decided the risks, now that they've sort of come to light, and ASIC's shining a very bright spotlight on it, that the risks in the market aren't worth it, and have sold their businesses and distribution channels. And more broadly, we think those governance changes, what we're trying to do is get insurers to build into their systems that design is done in a coherent way, that the whole life cycle of the policy is considered, that claims and complaints data is filtered in. We think those things are broadly consistent with what they should be doing anyway, but will also be what the legislation that's to come envisages. And we think if they're doing it for this product, hopefully they will start doing it for all their other products as well, so they have the advantages there. So that's the summary of the market. We're well into that work. We're at the moment still using our voluntary powers. We think in the end there will be a need for some regulatory intervention, that the dynamics of this market and the need for car dealers to develop a revenue stream or maintain that revenue stream means that while voluntary and persuasion and investigation has driven some changes, that to make that permanent there'll need to be some law reform or other regulatory intervention. Thank you.
Thank you very much, Christian. Birny, this may echo maybe to the developments you see in the US. So if you can give us insights of this from a consumer perspective.
Yes, thank you. Good morning. I'm so pleased to be here with you. Thank you for the opportunity to talk with you. I must say that after listening to Maggie and Christian's presentation, it's real deja vu for me. I've been working on problems in add-on insurance markets since 1991, and I can say pretty clearly that a corporate governance approach is not going to work, and I want to tell you why. So when we think about intermediaries, we often think about intermediaries as kind of the gatekeepers to insurance. So there are a number of smaller insurance markets in which the consumer is captive to the intermediary. The intermediary may be a lender or a retailer. Consumer credit insurance, payment protection sold by lenders, travel insurance sold by airlines, insurance sold by retailers. And so Maggie and Christian have discussed the problems with add-on markets, credit personal property in the UK and consumer credit insurance in Australia. These market outcomes aren't the result of the failings of an insurer, but a result of intentional design. The insurer is serving its customer, but its customer isn't the ultimate consumer buying the product. The customer is the retailer or the lender. And this is a well-known market structure. It's called reverse competition. And so in reverse competition, we talk about insurers that takes the form of them vying with each other for the favor of the persons who control or may control the placement with the insurers. In other words, they're the lender or the retailer is the gatekeeper. In a recent investigation of force-placed insurance in the US, the New York Department of Financial Services talked about this. Force-placed insurers have competed for business from banks and mortgage servicers through reverse competition. Rather than competing for business by offering lower prices, insurers have created incentives for banks and mortgage servicers to buy force-placed insurance with high premiums by enabling banks and mortgage servicers through complex arrangements to share in profits associated with the higher prices. So we've seen this around the world. The lender is the gatekeeper for credit insurance in a captive market. This intermediary determines what products will be sold to which consumers and how much of the premium the lender will extract from the insurer as consideration for the lender's market power to open the gate to the consumer. And economic analysis is critical to supervise these markets because you have to understand where the market power lies. Consumers have no market power. The intermediaries, the lenders or the retailers are the ones with the market power. And unless you're going to address that market power, you cannot address the problems. You can't say, we don't want you to charge as much commission. But why wouldn't a lender charge or get as much commission as he or she could when they've got the market power to extract that? So the thing is that over the past 10 years, the notion of a captive market has spread to other types of insurance products. And now it's no longer limited to niche products where you have an explicit three-party system. But captive markets have now spread to almost every other type of insurance because the new gatekeepers are big data algorithms. And without public policy action, the captive markets won't be limited to these add-on markets, but other markets will become captive where the control over access isn't with the lender or with the retailer, but it's going to be with the data vendors and the algorithms describing and scoring individual consumers or businesses. And this has big implications for the ability of small and medium-sized insurers to compete also, because access to data, there's greater access with the bigger companies. So let me sort of delve into this in just a little bit with big data algorithms as the insurance market gatekeepers. So in terms of marketing, so it's one thing to sort of do advertising, but it's another thing to do micro-marketing based on consumers' web searches, so that when a consumer is actually looking for an insurance product, they're pre-scored. The information is pulled about them and they're channeled to a particular product or a particular vendor or a particular intermediary. So in terms of supervisory oversight, it's a lot different than looking at the way intermediaries, human intermediaries work. We're now having to really look at how algorithms work and whether those algorithms are using data that are complete and accurate. In terms of pricing, for example, in life insurance now, there's something called accelerated underwriting, where the life insurer doesn't ask very many questions and certainly doesn't do a physical examination because they go and obtain information. You see that also for auto insurance and homeowners insurance, where the information is pre-filled in the application, pulled from a variety of data brokers' offerings. And the pricing is based not just on risk, but on price optimization and consumer demand models. How much a particular consumer is willing to or is able to pay in a particular market at a particular point in time, and whether there are other competitors in the market. So it's moving away from risk-based pricing to what we would call dynamic pricing. Claims, we heard yesterday an example of the ability to settle a claim within a minute. How do you do that? Well, the car provides you with the information about the damage and goes through an algorithm, and that algorithm immediately determines whether this is a claim that should be suspect and treated as potentially fraudulent, or whether it's cleared quickly. Well, what are the data that are used to determine whether somebody is a potentially fraudulent claimant or not? So the upshot of all of this is that it's the big data algorithms, the folks who are providing the data, the big data, and the algorithms that are now the gatekeepers, that are now the intermediaries. And the common characteristics are opaque algorithms, little or no disclosure or transparency to the consumer, and also little or no disclosure to human intermediaries. The human intermediaries that we've always worked with are becoming more and more marginalized. And of course, there's a concern about whether the most vulnerable consumers are being penalized because of their either lack of data or their absence of data in these. So what's needed? So I would suggest to you that in order to keep insurance markets competitive and fair to consumers, and in order to improve the insurance role for economic security, loss mitigation, resiliency, and sustainability, in other words, in order to fulfill an important role of insurance, supervisors need to look at three things. The first is to articulate what the future of insurance should look like. What do we want insurance to look like in 10 years? Do we want it to be more big data driven, opaque, with little transparency to consumers, or do we want it to be more of a partnership type of approach with full transparency to consumers? The second is that supervisors need to do a more expansive job of monitoring the market, monitoring what types of data sources and uses insurers are using, and also collecting data on market outcomes. And finally, I think supervisors really need to develop, improve, and reinvigorate your capabilities for the economic analysis of markets, competition, and antitrust. In some cases, there is going to be a need for supervisory intervention to align market forces with the interests of consumers. Right now, in a reverse competitive market, the market forces don't align. The market forces give the intermediary, the lender or the retailer, the market power to command considerations. So that market structure doesn't align the interests of consumers with the interests of the intermediary or the interest of the insurer. So it may well be that there's a need to intervene in that market to align the market forces with the interests of consumers. So you might need to actually intervene in that contract between the intermediary and the producer to say you can't charge 80% commission. So I want to close by quickly offering a couple of examples of good things. The Canadian Council of Insurance Regulators this year issued started an annual statement on market conduct. So all companies, life and non-life companies, will now make this fairly extensive report, which is a survey of conduct of business policies and procedures, as well as data on claims, sales, complaints, and lawsuits. So I would commend that. First, I'd commend the Canadian supervisors, but I'd also commend it to your review. But I also want to give you an example of something that a US supervisor did just yesterday. The New York Department of Financial Services is investigating life insurers' use of big data in insurers' accelerated underwriting. And basically what it turns out that life insurers have been waiving requirements for blood and urine samples. Instead, they're relying on outside data such as credit activity, property deeds, college attendee records, credit activity, evictions, and other public information to give them a sense of the applicant's well-being. So the New York Department of Financial Services sent out a letter saying, we want to understand more about what you're doing. We support innovation that reduces the overall time and expense of obtaining life insurance, but we want to make sure that the practices are based on sound actuarial principles and won't result in higher rates for vulnerable populations. So the letter specifically asks for about the algorithms that are used, the data sources that they're relied upon, and how the information is weighted within the algorithm. The letter also asks about disclosures to applicants and things of that nature. So I want to end with a question, which is ICP 18.1 says that insurance intermediaries should be licensed. So if the intermediary is now in reality a data broker, should there be a requirement for data brokers and the algorithm designers to be licensed? So thank you. I appreciate the time and consideration.
Thank you very much. Nick, I would like to have your reaction to Birny's presentation when he said, well, he described a world where everything is changing, where the new gatekeepers are algorithm, data vendors, and I think, Birny, you said that traditional small intermediaries were going to be marginalized. Nick, does this fit with your, how do you say, plea for stability? Do you think this, you advocated for stability in regulation? Do you think this is compatible with this world which is developing and moving and changing very fast?
Absolutely. I believe so, yes. Because the traditional intermediary is, when we talk from a technological point of view, then I don't like the word traditional. We are all what we call Inshore Hybrids. We are using technology to optimize the processes since many years. Now, of course, you have this data, you have the whole new world that is coming, but when you see what they're called fintechs or insurtechs, basically they are using techniques that are what some would call traditional. So from that perspective, these markets are coming together in one way or another. And yes, these are the dynamics of the market. We will have to live with that. And we just have to make sure that we are better and that we make sure that we can comply or answer to all the expectations of these new consumers. And they are also moving step by step. This is not from one day to another, and this will not be a big bang either. But I believe that our sector is adapting to the new world, which is something we do since many years. And I'll talk here as a sector as a whole. Supervisors will also have to do that, but I believe that what Birny said, but also what the other speaker said, is just an illustration of what we are calling for since many years. There is always a danger in bundling and tying. That is one thing. Secondly, something that I said earlier, there must be a level playing field, and regulation should be activity-based and should be all-encompassing. Whenever you have an exclusion or an exemption, there is a danger. But what we also see is that the supervisor is playing his role, because out of the millions of contracts that are sold daily, you were able to detect where the problems are. It's also an illustration of the fact that the supervisor can actively play a role without changing all the rules for everybody who tries to do good. So I believe that that is an interaction. Of course, you need a regulatory framework that can capture all this. And then the supervisor, when the supervisor and the supervisor is doing its good role, then I believe the priority is to take out of the market those who are really doing the wrong thing. Who decides what is wrong and good is a philosophical discussion. There are democratic processes for that, but I believe that that is the interaction. And if your regulation is high level enough, future-proof enough, taking into consideration that we are in any event in an Inshore hybrid market, and whether that is tech or less tech or whatever innovation, yeah, then I believe that there is no conflict between, on the one hand, a stable framework of the basics, on the other hand, innovation and a changing market. But it needs work, of course. Yeah.
Okay, thank you. Maggie, do you want to?
I think there's quite a bit there that I could comment on. First of all, I think my formulation sitting as a regulator would be that I think regulation has to have a large element of which is risk-based. So what is the harm? You know, what is going on? What is the problem? Which I think goes to your point. And at FCA, we have an objective around market integrity, and we have an objective around consumer protection, and we have an objective around effective competition in the interests of consumers. And, you know, things that we do pick up each of those threads, and not necessarily discreetly. So I think a couple of points, you know, practical things that we're doing in this new world. First is that we are doing some work on big data to see exactly what that does mean. What is the data that's being used?
Okay. Yes, probably that was a test to test our risk appetite. But Maggie, if you can resume.
So what I was trying to do was talk a little bit about a couple of things that FCA is doing. One is big data. Looking at big data, what does that mean? How does that impact risk pricing? Is it being used appropriately? Is it being used for good or bad? And that's one of the things we're looking at. The other thing kind of ties in with the innovation theme, which is you may have heard of our Project Innovate, our sandbox. And the point about the sandbox is to allow firms to experiment, come to us and say, we've got this idea and we'd like to try it out. Now, what it is not is a place where firms can play and have less regulation or try out dangerous ideas on customers. It's very much the reverse of that. It's a bit like learning to drive and you have to have an instructor in the car with you. So the idea is that a firm will come to us and say, we've got this really innovative idea. They have to prove to us that it is genuinely innovative. They have to prove to us that it actually has a consumer benefit. And they have to make sure they have appropriate consumer protections in place. But within that framework, we can let them try that out. And that actually, we're getting a lot of interest in this, and it's gaining a lot of traction in other regulators. So I think that sort of thing does to kind of bring together the innovation piece, which I think you're going to tackle more in a later panel, but the kind of traditional piece that you were saying, these might be traditional methodologies. How do we apply them in an innovative way?
Thank you, Maggie. I see that Nick wants to add a word, but if it's just a word, yes, please, because I would like to ask also a question to Christian. But
thank you very much. That's very kind, but I believe that sandboxes in the world that we are living in, with regulation, which is not only IDD or specific insurance regulation, this world is becoming extremely complex, and whoever or whatever Inshore hybrid you are, I believe that every intermediary or every insurer would now need this kind of dialogue. Yeah, and whether you call that sandbox, I believe we should have a continuous dialogue about where this market is going, what you are expecting from us, what we are expecting from you. So therefore, this kind of panels is very useful, but we would like to see that on a daily basis, and I'm afraid that we are not yet there.
Okay. Christian, may I ask you a question of what you mentioned about data? I also refer to Birny's presentation when he have 3 recommendations for supervisor, and one of them is monitor the markets with data collection. Can you give us more details on the way you think collecting data can move the market?
So it's something that ASIC's starting to engage with, and the add-on insurance work is, in a sense, being a pilot for that. It's the first area of insurance where we're collecting that contract-by-contract data. So we will get a range of information about the consumer's circumstances, about the loan, about the car, and about the insurance policy, including claims. There's currently a pilot with insurers. What we expect to get out of that is identifying a number of different value measures. So loss ratios is an obvious one, but our thinking is we will probably get 5 or 6 different value measures out of that. The rate of commissions to claims, for example, currently 4 to 1 or more in favour of commissions. The average amount of claims, so you might be insured for a maximum of 20,000, but if most claims are for $4,000 or $5,000, then there's probably a mismatch there. So we are looking to get a number of value measures like that and then use it to inform consumers and that part we haven't worked through yet, but the idea is that particularly with these add-on products, consumers have no sense about how they'll work in the future, that there's an element of trust, but the future outcomes are not visible. So the idea is that we would try and get some value measures that become public to both inform consumers and identify outliers amongst the insurers themselves to try and improve. And that model would, once it's worked through, would probably be capable of being adapted to other sort of products as well.
Birny, do you want to comment?
So, having worked on these issues for many, many years, I just wanted to throw in a couple of suggestions that it would be also useful to get information on cancellations, how frequently consumers cancel the product, because one of the aspects or characteristics of these add-on markets is that it's a high-pressure sale. You're buying a car or you're buying a product and you have to finance it, and there's somebody there saying, this is a really good product for you. It's very easy to sort of have an abusive sale where the salesperson indicates that you're not going to get the loan or you're not going to get the product unless you buy this add-on feature. So that's another sort of characteristics of that. The other thing to look at is the amount of the coverage. In some cases, the amount of coverage far exceeds any kind of benefit that a consumer might get. And then on the flip side of it, there's the benefits, for example, in a credit unemployment product, may be so minimal that they don't really meet the consumer's needs. So those are things to look at also.
Thank you. I think it's time maybe to open the floor to the audience for any question.
Dave Sandberg, more of a personal question, but one of professional interest with the International Actuarial Association. I'm curious what regulatory authority exists for entities that in a sense are outside the traditional insurance jurisdiction. So, and what comes to mind is obviously taxis are well regulated around the world, and there's very strict requirements on who can drive a taxi, but that hasn't prevented the market from seeing entrants come in who are not regulated. And so I'm curious, is that a possibility in the insurance arena? And if so, what are your thoughts on how to address that?
Okay, who wants to think maybe Birny and then Maggie?
So I'll take one piece of that, which is in the U.S., insurers are allowed to share data with one another through an organization that's called an advisory organization. The idea being that individual insurers may not have sufficient data to really manage their risk or do their pricing well, so that by working with an advisory organization, a number of insurers can submit data, the advisory organization collects it, and then produces essentially collective pricing assistance through what's called prospective loss costs. So those are licensed. They're specifically licensed to avoid or get around sort of antitrust concerns, and they're licensed so that supervisors have oversight of their activities. And the basic concept there is you give information and then you get some kind of pricing assistance. Well, now we've seen all of these new entrants, credit scoring models and all types of other scoring models that functionally are identical. They've collected insurance claims data, they've analyzed it, and now they're putting out tools to assist insurers with pricing. But those are not being supervised as advisory organizations. So there's a real question about what is the supervisory reach to these organizations that are involved in assisting insurers through collective pricing mechanisms. So that would be one example I'd suggest.
I think I'd probably offer a couple of insights there. The first is actually goes back to the Insurance Distribution Directive. In the UK, we have chosen to, if you look to ancillary insurance intermediaries, such as motor dealers, Christian was talking about travel agents earlier on, we require them to be regulated. They are within our regulatory perimeter. So actually, we have gone further than the Insurance Distribution Directive there. So where there is scope as a regulator, you can do that sort of thing domestically. The other thing is that ultimately, certainly in the UK, I can't speak for other jurisdictions obviously, but in the UK, what we can and can't regulate in terms of the firms we regulate are what we call within our regulatory perimeter, which is laid down for us by the UK government. So if you take an example, we have at the moment, there are firms, very often undertakers, who provide funeral plans. So people can save up to bear the cost of a funeral plan when a loved one dies. Now, at the moment, subject to certain exemptions, they are outside our regulatory perimeter. But we have seen some calls in the UK, some to say, actually, they should be brought within our regulatory perimeter. So I think there's two sides to it. One is what, as a regulator, you do with the perimeter that you have, and the other is whether you have that regulatory grip, and in certain circumstances that might take legislation to give you that grip. Certainly that's how it works in the UK.
Nick, you want to react?
I have an add-on question to this. That is that, are we really always talking about insurance? Because every retail firm, an online retailer, is selling furniture with an embedded chip that is sending a message that when the table or the chair is breaking, whatever the cause, that the day after he delivers you a new one, without asking, without doing, whatever the cause, are we then in warranty, guarantee, or in insurance? And would this, on a large scale, be supervised by insurance supervisors or somewhere else? And this is Internet of Things issues and so on. So this is an add-on question to the supervisors in the room, if I may.
Thank you very much. It will be very useful for work, for future work. If there are any other comments, maybe any question?
I would like to have an answer.
That's the answer is that we are going to consider this.
I recognise the issue. I think there are two things there. One is that the Internet of Things is going to bring that into sharper focus. The other point is that does exist at the moment. And we've had some debates in the UK where, if your boiler breaks down, for example, for your central heating, what have you bought? Have you bought a service contract that somebody comes out and fixes that, or have you bought insurance against the boiler breaking? And we have had some, let's say, interesting debates in the UK with the firms providing this about whether they might say, oh no, we're not providing insurance, we're providing a service contract, and we might look at it and say, well, actually, no, I'm sorry, you're providing it. So I think it is an issue now, but I think you're right to identify that the Internet of Things will make that a much sharper focus, if that helps.
So
yes,
I'll jump in, which is, I think there's a pretty sharp demarcation between collection of data or generation of data. So if I have a wearable device and I'm generating a lot of data and somebody's collecting it, that's one thing. But then if the person who's collecting it then turns around and develops an algorithm for an insurance company to use to either market or sell the product, then I think at that point they've become an intermediary.
I think we've got the temptation to speak about the subject, which will be the subject of the next round table. Are there any other question? Yes?
Particularly Birny's presentation is very enlightening and also creates some concern. What you mentioned is data holder. Let's say, well, very simple example, a social network, huge company have huge data and use algorithm, for example, and they shop insurance companies which could pay very high commission and then offer that product to consumers. So that's a kind of scenario, very negative scenario that could imagine. But my question to you is, you raised one example, you put one example in New York, but are there any more example? Potentially, I see huge concern, but are there any real example exist that, data and those become data holder, those become gatekeeper and shop insurance company and offer product which is not so beneficial to consumer, but to this data holder itself?
Sure. So many of you probably have heard that the EU is seeking to fine Google a couple of $2 billion for their abuse of their market position in the search market, because Google has 90% of the search market. And one of the charges against Google is that they prioritized or presented in searches things that actually were favorable to Google because they had arrangements with the people who they highlighted. So let's say you're Google and you've entered into a partnership with certain insurance companies in which they pay you to sort of highlight or put at the top of the search their products. Well, if you are in a dominant position in the search market like Google, then that has the obvious potential to sort of steer consumers and limit their choices. Similarly, Google employs a bunch of data to tailor ads, as well as Facebook does the same thing, and Amazon does the same thing. They have collected massive amounts of consumer information in order to tailor ads to you. So if they're working with particular vendors, then it's very likely that the ads that you see are going to be ones that either benefit the data provider or the relationship that they've had. We've seen that in the US with lead generation. You go to a website, an agglomeration website where you're supposedly shopping for a particular product, but as soon as you log in or go to that website, a score is generated for you, and based on that score, only certain products are offered to you and at certain prices. So that kind of dynamic pricing and product sort of steering is the kind of thing that I think should be of concern to supervisors. Again, not wanting to sort of stop innovation, but encourage it in a way that is more transparent and has some basic consumer protections. Did that answer your question?
Thank you. Any other question? I had one. Listening to your presentation, I think We spoke, of course, of conduct of business, of fair treatment of customers, but we also spoke, maybe without quoting it, but we spoke about competition. Nick, I think, mentioned the level playing field, but also in the presentation of Maggie and Christian, there was an aspect on competition. I think, Christian, you said competition did not work, and clearly, Birny, you explained us that this has many things to do with competition. However, conduct of business supervisors do not have, generally speaking, a mandate on competition. So my question to the panelists would be, do you think this is a difficulty? I know that some of you, Maggie, you've got a mandate on competition. How do you articulate this? Do you think there is a difficulty in articulating conduct of business supervision and competition? And in any case, do you think conduct of business supervisors have got all the tools to address these issues? Maybe, Maggie, you can start with your experience in the FCA.
I think it is interesting. I think we're unusual amongst regulators in having a competition objective. Our predecessor, the FSA, did not. I think the first thing is to be clear about what you mean by a competition objective. And our statutory objective is articulated as effective competition in the interests of consumers. So that's one. So that is not a competitiveness objective. We have to have regard to market integrity, we have to have regard to consumer protection, but it's not a competitiveness. My job is not to make the UK insurance industry more competitive at the expense of all else. We would hope that, you know, it would be a competitive industry, but that's not my job. I think the other thing is, and we do come across this, is that being a competition regulator is not necessarily the same as being a price regulator. There have been instances where we have put in price caps in the UK as a regulator, but those have been where the government has required us to put in a price cap. So it's not necessarily the same as being a price regulator. What I think it is, having explained lots of things that I think it isn't, what I think it is about achieving a balance, and it can be very difficult. We have a whole competition department. They will do market studies. So, for example, they will look at a particular market and ask, is this market working well with regards to its integrity and in the interests of consumers? So, for example, is there a concentration risk? Do you have a market where there's maybe only several large intermediaries? Or do you have a market where, for whatever reason, people are priced out of the market? Now, these are difficult questions. Very often we are asked questions around access to insurance, and you answer the question, you find the person asking the question is really interested in affordability rather than access. So it is a difficult balance, but it is about getting a balance between having a competitive market and a market that is safe for consumers. And you may remember that a while ago the UK government considered having a market in selling on annuities. And the reason that didn't come to pass was because we could not really find a way to balance the one with the other. So it is a tricky one, and I can't pretend that we would always get it right. But it does make for some interesting work.
Okay, thank you very much. Birny, do you want to comment?
I wanted to sort of offer a couple of scenarios and to suggest that sort of competition might be relevant for conduct of business. Right now, there's a growth in consumer-generated data through telematics from the automobile or from the home, devices in the home, or wearable devices. So for an auto, the telematics might be generated through a device that the automaker has built into the car. Who owns those data? The consumer's generated the data. Does the consumer own that data, and does she have the ability to take that data with her from one insurer to another insurer? Or does the data belong to the auto manufacturer, who can sell it and reap rewards because they now have insights into particular consumers? We have one company in the US, Allstate, that has said that they're going to be collecting, they've had telematics data from millions of vehicles over many years, and they had planned on selling that in the same way that Google sells web searches. So that's sort of one example in terms of, in terms of competition. How do small and medium-sized insurers compete when large insurers have access to those vast amounts of data? If the largest auto insurer enters into a partnership with the largest auto manufacturer for telematics program, is that profoundly anti-competitive? Is that something that supervisors need to look at and say, this is really creating barriers to companies entering the market to offer telematics programs? So just some questions, no answers for you, unfortunately.
Thank you. That's stimulating for the future. I think we committed ourselves to stop at 1 o'clock. So I think we are in time. No other question? We'll close the session and maybe there is an announcement. Yes.
So thank you very much. So you can see, IAIS work not only capital, confirm ICPs, but also market conduct. Of course, market conduct is a part of ICP, but it's an excellent panel. And there's a profound issues that we should tackle, particularly current new development of technology and data issues. So thank you very much again for the panel. So that's, now we have a time for lunch. So we have lunch the same place that we had yesterday. And of course, coffee will be served. So we will kick off next afternoon session at 2 o'clock. Thank you.